The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Whites, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, good morning, and welcome back to the show. I'm your host, Peter Weitz. You're listening to the In Black and Whites radio program on the Voice America Business Network. A quick shout out to our sponsors, the law firm of Weitz and Andrus, who will be joining us here in a couple of minutes, American Century Investments, and Stephen Douglas Associates. For those that listened last week, I really appreciate the feedback. We got some great response from you, and I know you all really enjoyed listening to Raj Raywal from the Fresh Diet, as I can see by the post on the blog. Today we have an interesting show, a little bit of a different twist. I've got with me Joel Mayersohn, who is a corporate securities and business law attorney from the law firm Weitz and Andrus, as I mentioned. He particularly focuses on private placements, public offerings, mergers, acquisitions, financing, and general securities as it relates to corporate law. And what I wanted to talk about today was sort of the crossroads of a business. And, you know, down here in South Florida where I'm based, typically most of our businesses are smaller in nature, owned by one or two owners. And what happens is they end up growing their business, they get profitable, they get larger in revenue, and they get to a certain point where they can't continue to fund the business that they've gotten to, and they get a crossroads. And what do? Do they raise additional equity through other partners? Do they get acquired? Do they go public? Do they sell? There's a whole host of things that they need to plan for and think about. And we're going to talk about that today with Joel. So welcome to the program, Joel, and I'm glad you're here.
Thank you, Peter. It's a pleasure.
And I certainly hope, for those listening, Joel's up in balmy Minneapolis today where it's 10 degrees. So, Joel, if your voice starts to freeze over, I'll totally understand.
Okay.
So, you know, I introed the show by saying that, you know, businesses hit a crossroads. And I guess I want to just start out by saying is, when does really a business owner know that they're at that point? Is it they can't afford to support inventory? Is it they can't afford to support or pay for growth? I mean, when do they hit that point?
I think there are, you know, those are both examples of when that would be. There are a variety of different times when they're, you know, looking to expand, and they don't know where they're going to get capital to be able to do that. Where they're at the point in their time when they're kind of looking at the nature of their company and seeing who the people are and what they need to do to get to the next level. When they look at competitors out there that are growing and they're behind the curve slightly because they don't have the capital or don't have the infrastructure, or things are just going great and they're just deciding that, you know what, I've worked really hard. I've put in my time. I don't have necessarily a plan of succession that I need, and I want to kind of move on to something else and made this successful. Or alternatively, with a lot of businesses, they need a lot of capital to get to the next level, or there may be a competitor out there that could potentially swallow them up. And the cost of fighting that competitor could be awfully difficult. So it's kind of by choice they're forced to make a decision.
And I think for the purposes of our discussion today, Joel, I want to focus more on, you know, that middle market space of businesses, not necessarily, you know, the multinational conglomerates of the world, but the more the mom and pop, the companies that, you know, started in the garage or something like that and grew into a decent sized business. And so I hope we can gear our conversation toward. All right. So you get to this point in your business cycle where you've grown to a certain level where you reach this critical juncture. What are some of the things that a business owner can prepare? What can they do to start to prepare to think about going to that next level, to taking that jump to the next level?
Well, once they kind of realize that they need to take that jump, they really have to start thinking about kind of what's the best option for them. And obviously not every option for every business is the same because it depends upon the nature of that business. Is it a business that there's only one senior person, or this is a business that's in a niche that's growing? So what they really need to do is kind of sit back and think a little bit and kind of, because the process always takes much longer than people think it does. It's not, because there are both, internal and external factors, there are market conditions, there are personnel conditions. So what you really need to do is kind of almost do, it's, since spring just started, and I hate to use a cliche expression, but it's almost like a spring cleaning. It's a time to reflect and kind of look at the company's current business performance, to see what's working and what's not, what they need to do to get to that level, what they're willing to do to get to that next level, meaning are they willing to, how much harder are they willing to work, how much longer are they willing to work, are they willing to give, and we'll talk probably about a little later, kind of personal guarantees on transactions. Kind of what's their goal? Is their goal to grow this company from a kind of nice sized company where it does gives them a good income, provides for their future, provides for their family, and to a company that could be worth hundreds of millions of dollars, and also kind of look out there, kind of and see what that competitive landscape is out there. Who are their competitors? What products do they have, and in those products, is there something out there that is going to become a product that may become obsolete, or do they have the next, in a technology area, the next cutting edge product? And what they really need to do is, if they have some issues, to kind of start looking at, corrective actions, to sit with their lawyers and their accountants, and kind of, if there's some problems, clean the house up, make sure it's in order. And one thing that we see kind of going forward when people come in to talk to the business owners, a lot of small to mid-sized businesses, can talk very kind of passionately about their business, but when they need to talk about financial information, or they need to talk about some really detailed things that investors or lenders or even competitors may want to talk about that are not kind of just direct business issues, they can't give kind of really crisp, concise answers. And a lot of times that can be a turnoff to a potential buyer or even a potential funding source.
And so you mentioned that they need to get prepared for where the next step is in their business. And, I'm a business owner as well, and I don't know that I actually think about that. So are you finding that when clients come to you that they're coming too late?
Yes, a lot of times it's not too late, because you can always work with them to get them to a point that they're ready to either sell their business or buy another business or get some source of funding. But it just makes it a little bit harder and sometimes a little bit more expensive, because the earlier you look at things, usually the easier it is to deal with any potential problems. So, especially kind of if there are potential legal issues, there are certain contracts that they may have put together that could be problematic if there needs to be an assignment. So that all along you want to, have professionals that you can consult with in the process. You want to be making sure your financial statements, to the extent that you have audited financial statements, obviously that much better, but at least if you have reviewed statements or some sort of financial package, some financial professional, accounting professional is taking a look at that, recognizing that if you're doing a transaction, a lot of small to mid-sized companies or S-corps or LLC and their pass-through entities, to start thinking about potential, tax scenarios down the road. And the earlier you do that, the better off you are, so that you can do some tax planning when the time is right. And there's always a kind of tension that we find with a lot of our clients, because they don't necessarily, they're like, why do I need to spend the money to do that? And, there's an old adage that a pound of prevention is worth an ounce of cure, and that's kind of the case here, that you're much better off kind of at least taking a preliminary look as soon as possible about everything and just kind of doing a evaluation of what you have and where you need to go.
And so you make mention of, you made a comment called getting the house in order. And, I want to focus on that for a minute or two, in that how do business owners sort of separate themselves from the emotional side of it's my baby and I have the best looking baby against what the real facts of their business are? And it might be a pretty lengthy answer, but I'd like to hear what your comments are on that.
It is one of the hardest things to do, because so many small and mid-sized business owners are, it's their, it's who they're recognized by who they are sometimes and the nature of their business. So they need to try to take emotion out of it as much as possible, and they need to kind of rely on their professionals, their lawyers, their accountants, and hopefully there are some people in their business that they have that they can consult with. There may be a trusted, kind of individual in their group, or if it's a family business, they're members of the family that can go together. But they really just need to kind of step back and almost kind of view it as if they were going to look at another company, is the way that they should be looking at their company a little bit. When they look at a competitor or look at another entity in the field, or just another company, when they pick up the newspaper and look at a company when they buy a stock, they make some hard valuations about what a business is all about, and that's what they need to do. They need to kind of just go back and say, okay, where do I want to be? What do I want to do? Kind of realistically, what problems do I have and how they can solve them? Because most business owners usually can be, ultimately objective. It just takes a while to get them there. And, that kind of also carries through when you do the transaction process, because too often a lot of business owners will look at it and say, why do I need this? Or I'm going to fight for every nickel and dime. And while that's important, you have to keep your eye on what the ultimate goal is in any transaction.
Yeah, and we talk about that a lot on this show because, as managing money, I have to manage emotion more than anything, and most of it comes down to fear of greed. And if I find that, some of my clients are greedy, I have to put the fear of God into them, and vice versa. If they're scared, I got to make their greed come out. And I think I guess it's germane to any business. I want to touch base on that a little bit more, and then I want to get into a couple of other thoughts. But I'm going to take a quick break, and you're listening to the In Black and White's radio program on the Voice America Business Network.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled Weitz. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hey, thanks. Welcome back to the show. I am your host, Peter Weitz. We're joined today by Joel Mayersohn, a corporate securities attorney at the law firm of Retzel and Andrus. And before we get back into it, I want to invite you all to please send me an email if you have any questions for Joel at peter@inblackandwhites.com, or you can hit us up on the blog at In Black and Whites. I'll also be tweeting at my handle at Peter Weitz some of Joel's comments throughout the show. So if you have any interest, make sure you follow me there. But prior to the break, we were talking to Joel about the emotional side of a small business owner, in that, you know, it's their baby. They feel it's worth more than anything else in the world. And, you know, they have these visions of grandeur when they think about their business versus what the numbers really support. And Joel was talking about some of the tactics that he uses and some of the experts that he works with to take the emotion out of it. But I think it leads to an interesting comment in that when you hit that crossroads in your business, Joel, you now have to decide what you're going to do as your next step. And it comes down to that critical juncture where you have to figure out, what's my business worth? And that, I think, plays in really well with the emotional side, because I'd imagine every client that comes to you thinks that they have the next Microsoft.
Without question. Everyone thinks they have a great idea, and they don't want to give away, you know, a lot of their business if they're doing a capital raise, or if they're buying another business. It always turns out that business is worth less than theirs for a variety of different reasons. So what you really need to do, there are a couple things that you can do on the valuation side. One, obviously you can look at comparables. If you know that one of your competitors has sold their business, you can, if there's companies in your space that have recently done some public offerings, and they're all different sizes of public offerings, you can get an idea of what the market is. You can go to a professional to help you with a kind of evaluation. They're all different kinds of valuations, obviously, and the breadth and depth of those and the cost for those are obviously kind of run the gamut as well. But you can do a preliminary one to give you an idea of what it's worth. You can also, in your mind, get an idea, kind of a perception of what you think you're worth, and it also depends upon what you want to do kind of down the road. Do you want to stay on? Do you want to get out? You need to think about some of the tax issues and, what you're really going to end up with. If you're looking to add on some debt to do some things, talk to a couple of bankers and have them talk about how much you can leverage. Bankers are always willing to talk to you and have some conversations, and we always introduce our clients to some bankers, and they can tell them, hey, here's what the market can bring. If you have some information, you can give them, and that goes back to the concept of being prepared, that you can give them some basic information about your business, some basic financial information, where they can give you an idea of how much you can leverage and whether you're going to need a personal guarantee or what kind of additional support you're going to need, and what kind of restrictions in that leverage you're going to have as you go forward. And also, as you look towards, if you're looking towards doing some acquisitions, you can talk to some investment bankers or your lawyers who have done some deals in your space to get an idea of what targets are expecting. What kind of multiples can they expect of their business? What kind of terms can they expect for a transaction? Are those people looking to stay on? What's the difference between doing something in a public market versus a private market in valuation? So really try to get a good feel of ultimately its worth, and also as the owner of the business, in your mind, get it. If you always ask people, kind of, what's your number? What are you willing to do if you're going to sell your business, okay, or you're going to buy and then ultimately move towards growth? Where do you see yourself, and where do you see kind of the number that if someone said to you right now, that's what I'm willing to get out for, or that's where I want to be, or how comfortable I am, with ultimately kind of indebtedness on a business, and kind of thinking if there's some issue down the road, how comfortable can I be to do that? Because one of the things you want to be sure about when you ultimately do a transaction is at the end of the day, you don't have seller's remorse, you don't have buyer's remorse, or if you're taking on some indebtedness, it's not to the point of, making you feel uncomfortable at night, or you're, waking up in the middle of the night and can't sleep because of that. There may be other reasons you can't sleep, the nature of your business and just because of the type of person you are or what you're doing, but you don't need another transaction to do that as well.
And so we've obviously, there's three basic ways you can position your business. And I kind of want to spend the next several minutes talking about each individually. But the first one you point out, obviously, is finance, is to raise money. And there's two ways we could really do it, either through, private debt or bank debt, or to go public. And I'd like you to focus first on the bank side of it and give me some insight as to what you're seeing in terms of what a business owner can expect to have to give away, or what they can expect to have to pay if they raise private debt.
And if they're raising private debt and their business, and we're looking at kind of what would be a kind of substantial kind of a business, one that's profitable, one that has cash flow versus a kind of a startup scenario. Generally, what investors are looking at in a transaction is some sort of preferred return, or if they're doing on the debt side, or just some a kind of an interest rate, and also a lot of times if it's private debt, kind of an equity piece, so that they become partners for you. I mean, valuations are all across the board. They're starting to obviously improve from the company point of view from where they were a couple of years ago. And there are a lot more people out there that are, whether it's a private equity firm, whether it's high net worth individuals that are looking at transactions and have cash that's available to do a transaction. But it's one that, those transactions, they're going to put, kind of, I wouldn't use the word handcuffs necessarily, but they're going to make sure that there are covenants in which the way in which you ultimately operate your business, about things that you need to do that you're going to ultimately have to go back to your debt holders, that there may be kind of ratios that you may have to perform, and generally in a lot of the high net worth folks, there's not so much ratios, but things that you can't do. You may not be able to incur additional indebtedness. You may not be able to sell the business unless they're paid off and have gotten a certain return. You may not be able to, kind of just turn around and bump up your salaries or make distributions above and beyond certain amounts before that debt is paid off. So there'll be restrictions along the way, but and in a bank scenario, a traditional banking scenario, you're going to see covenants. You may see a personal guarantee as part of the process. Hopefully you try to limit that guarantee as much as possible, but banks are obviously, in today's world, trying to tie things up as tight as they can. So you're going to be, as an investor, looking for the best deal, and the company obviously is looking for the best deal on their side. And that goes back really to that emotion issue. You got to also, in those scenarios, take emotion out of it, because what you want to be able to do is kind of walk out of that transaction in one that kind of works for everybody, because as we've seen in recent years, for a variety of different reasons, some which can be, not in control of the company or the owner of that company, there are changes to the world, the economic markets, the capital markets, the just general business markets. And if you have some private, investors that you can work with, or bank people, and you haven't kind of skewed the relationship from day one, it's going to be much easier if for some reason you miss a covenant, or you breach something for a period of time and you think you can get back in. So you want to treat these people as your partners. You want to work with them going forward. You obviously want to get the best deal for you, and that's important. But again, when you negotiate these transactions and do them, you want to focus in on what the real important issues are.
And you make mention about going to the banks and so forth. Are you finding that the banks are starting to open up the coffers a little more and loosen up coming out of the last recession?
Oh, most definitely. There's a lot more lending, opportunities out there. They're being, more cautious they were in years past, but that's a good thing. Because, too often a lot of banks and people were too free with credit, and ultimately the companies couldn't support it. So but there's definitely a lot more opportunity for people to go into banks and get transactions done nowadays.
And are those transactions sort of more conventional, or are they still the typical high interest rate, or are they more reasonably interest rate deals? Or does it depend on the business?
I mean, obviously it depends on the business and, where the business is, but there's a lot more reasonableness to that. And even a lot of the private investors for good solid companies are being more reasonable. They're still looking for, good equity pieces, and they're looking for, solid returns on their investment. But there's definitely a lot more opportunity out there at rates and transactions that make sense for the companies.
And what about now you get to, and we'll spend a little more time on this on the other side of financing because it's a lot more complicated, but, what does a small, medium-sized business owner do, or what steps do they need to take if they actually are thinking about going public with their company?
Well, I think really, it goes back to the earlier conversation that we had, is they really need to get their house in order. They need to have, start off with financials. They need audited financial statements. That is probably the key thing, and the one that usually will hold up the process longer than anything else, because obviously in the public markets you need audited financial statements kind of immediately. And companies that investment banks are going to take you public, or if there are alternative ways in which you can go public with not a traditional investment banker. At the end of the day, that's the first thing, and those can take a while. And a lot of times in small to mid-sized companies, you have to kind of definitely clean up the house there and kind of look at the kind of almost. And I'm not using the word restate as far as a restatement of financial statements, but kind of look at the things that you're running through your business as a private company where your goal isn't always from a tax point of view to make money. There you have different kind of goals. Where a public company, your goal is to show income. So there is definitely a schism between the two, shall we say? So that you kind of look at do almost a readjustment, and people will look at those transactions. You also have to be involved with your lawyers and kind of look at agreements and contracts you have. And a lot of agreements and contracts you have, like you want to have employment contracts with all your key personnel. You want to make sure if you have any intellectual property rights, which you should have anyway, but that those rights are secure and that they are fully vested in the company. Want to make sure to the extent that there can be non-competes from key employees that you have those in place. So you want to have as many key documents in place for the public company context, kind of sooner rather than later when you start looking at that approach.
And when we get back from the break, Joel, I think what I want to touch a little bit more on sort of this going public concept, and then we'll get into your two other ideals of being acquired or potentially selling your company. But I'm going to take a quick break, and you're listening to the In Black and White's radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm your host, Peter Weitz. We're joined today by corporate securities expert and attorney from the law firm of Retzel and Andrus, Joel Mayersohn. And before the break, we were talking about what companies or what small to mid-sized companies can do to acquire financing. And we left off this segment talking about going public. And I'd like to talk a little bit more about that, Joel, and that all of a sudden now a company's faced with potentially going public, and they think about being a publicly traded company. And there's really, from a small perspective, 2 angles as I see it. Number one, they can register themselves and go public, or they can enter inside of it, what's called a shell. And I'd like you to comment to our listeners on, first, what actually a shell is and how it differentiates from, registering their own security, and the differences between the two in that regard.
Well, a shell is an existing public company that effectively has no assets or operations. It may have been one that was specifically formed for the purpose of being a shell, or it may have been a company that went public several years ago and for whatever reason fell on hard times, effectively liquidated all the assets, but still kept its public company filings going. And that is versus...
Can I interrupt you right there? So
Sure.
What happens to who are the shareholders of that, and what happens to those shares of stock? I mean, are they just out there?
Well, the company that it was, originally a public company, the shareholders are still out there. There could be a group of shareholders, and at times what happens is there may be groups that come in and buy up have bought up blocks of those shares for a period of time where they ultimately have a control position, and what they're selling to the business owner is that control provision. So it's a way for them, and they will keep some stock for themselves, so it's a way for them to effectively sell the shell. So they're selling the shares, selling control, and keeping interest for themselves. And there's certain rules and regulations, which are kind of much too detailed for this phone call and this kind of hour, about how, is that stock free trading, what's free trading, what's not free trading, how long you have to hold it. But one of the things generally is when you do a shell transaction, is you start off with that transaction, and generally you have to then kind of take your audited financial statements, file with the SEC, what is known as a Super 8K. And that Super 8K effectively is what like a full-blown prospectus. So it's a complete description of your business. It's a couple of years of audited financial statements, and you file that, and then the company is really will continue the reporting process. And generally, in most scenarios, and we're talking with the smaller companies, you continue to file those registrations, the 10Qs and your 10K for a year before you can do your next kind of larger transactions. And a lot of times when you do a shell transaction, you'll couple it with a private financing, so that you may get some additional capital in there to do what you need to do. For example, if you're doing it to try to do some acquisitions, you need some capital. But one of the advantages, obviously, of the shell, all things being equal, is that you can get to be a public company quicker. So potentially, if you're looking for a market, so you can show someone that you have publicly traded stock, that there may or may not be a market for that, and that's another story. And you want to do an acquisition, people can see that right away, and it can make it a little bit easier. Your traditional registration statement is what we see all the time. You're doing it on an IPO. You engage a investment banking firm, an underwriter. You file a registration statement with the SEC to sell securities of your company, whether it's stock and warrants, and you file that registration. It goes through SEC comments. You go through the process. You go on with your investment banking firm, road shows as part of the process, and ultimately that if the investors like your story. After a period of time, the underwriter has filled up their book with orders. You kind of agree on a price, and you have your registration statement declared effective by the SEC, and you become a public company, and then have reporting. Now, obviously, most times in those scenarios, the advantage you know who all your investors are right away. There's a lot of times with this shell scenario, we've heard, and everyone's heard horror stories. There are fewer and fewer of those because, if you go to the lawyer and they do the due diligence and you're aware of the scenario and you kind of know the shell history, things don't pop out of the woodwork, but occasionally they do because, unfortunately, especially being in South Florida, there are some bad eggs in the shell game. But they're bad eggs in any business, and our job as lawyers is to make sure that we make you aware of the different scenarios and the potential pitfalls of those transactions. But it can be done rather quickly. The public offering market has tremendous advantages. If you get listed on an exchange or NASDAQ, you have significant credibility. When you go out and if you're looking to grow by acquisition, it gives you an awful. People will respond to that sometimes better than they would if you had done a shell transaction. But there are pluses and minuses to both.
As with anything, and so here I am, a business owner, and I've looked at the debt side. I've looked at selling away a piece of equity in my company by going public, or potentially having to give away a piece of equity by acquiring some debt, and I don't like either of those options. And so now I have a couple of other choices, and one of them is to be acquired or acquire someone else?
Well, you can do a couple things. You can obviously be acquired. And then the questions when you're being acquired is kind of who's out there to buy. So if you're looking to acquire someone else, what companies are out there? And when you start looking at those companies, you obviously need, there may be people that you have long relationships with. It could be a supplier, simple as that would add some value, or someone in your distribution channel, or it just could be a competitor that you're approaching. So and obviously with that there are a bunch of issues. What is that company or that individual or that entity wants to buy? What's the cost to buy it? What are they expecting kind of on a going forward basis? What's their timeline? Are these people going to be your partners, where you're kind of doing it as a kind of merger of equals, or ultimately they're the successor to you as the business owner? What about your existing employees? How are they going to look at it? What's your business culture like? And again, those become sometimes very, very key issues, and they become very emotional issues. So you have to sit and look at those, and what's the tax structure of this transaction going to look like when you start buying different entities, and what are the impediments to buying? What kind of consents are needed? Do they have bank debt? Is that bank debt going to be brought over? If that bank debt exists, it's going to throw you out of covenant on your bank debt. Does your banker, like this transaction, and they're going to say, okay, if we got to add a few $1 million to your bank line because you're, bringing over some revenue and you're bringing over profits, that's great. What kind of financial issues? What's are they growing? How much money are they going to need? How much more, kind of overhead are you going to add? Are there, everyone uses the word synergies, but there's also the cost of integrating businesses. Sometimes it can be very, very easy. Sometimes it can be very difficult. And sometimes those synergies, they're just cultural differences. And the concept of general compatibility. Everyone has a different style, and too often when people look at transactions, a lot of times they look at the economics, which are obviously very, very important, but you have to look at the social and cultural issues as well, and of course the legal issues and the accounting issues that go along with it. So again, that process just is, kind of the process of getting your house in order, kind of figuring out what you need to do. The concept of going to acquire a business can be equally as difficult. And we've seen hundreds and hundreds of transactions, many of which have gone down the line and gone fairly far, and gotten to the point of being close to final documentation, and it just doesn't work. There's something, whether it's a consent that can't be achieved, whether it's the economics don't work, or whether it's just, after the parties kind of spend time with one another, they kind of say, what, this is just not going to work. We kind of have some different goals here. And, that's something that everyone has to think about. The other issue really then is, if you want to be acquired, and that's many of the, the sell. Why do you want to sell? And what do you want to sell? Do you want to sell, you may want to sell off a subsidiary of your business because you think, it's not fitting your growth pattern. Or maybe it's something that you think that it's kind of economically really good and you can get a benefit out of it because there's someone that may be able to do it better. How are you going to get paid for the sale? Do you want cash? Are you, if you're selling to a public company, you're going to get stock in that public company. And what does that mean? When can you sell that stock? What happens if the stock goes down? Am I protected on the downside? A lot of transactions when you're dealing with kind of smaller, kind of mid-sized companies have what are known as earnouts, where you get paid based upon your performance of your business going forward. And that is always a difficult issue to negotiate because what has to be included? What if the person that's acquiring you or the company that's acquiring you is not giving you the capital to grow? What if or they're growing, but they're adding on a lot of debt and a lot of obligations and you can't necessarily meet your numbers? So all those things have to be thought about and negotiated in the agreements. There are issues of indemnity. How long will that last? How long before ultimately, your potential acquirer can come back to you and say, there was a piece of litigation out there that happened based upon something that happened in the past, or a tax authority comes in and says you didn't collect sales tax and therefore we're going to go back to you. How long does that last, and when are you effectively clear from that? Also, who's out there to buy you? And how does that affect your value? Are you being bought, by a public company? Are you being bought by a private equity firm? Are you being bought by a competitor in your space? So the competitor may say, this is going to give me tremendous value because of the combination of the two entities. It's worth more to me because I'm able then to control the market. I can pay you more. Than somebody else. This fits a specific need for what it is versus a private equity firm who's, in their mind, they're looking for a return on their investment, and that may kind of, in order to achieve that investment based on your present financial performance or where they think it's going to go, may be less. What happens when you're being acquired, and even when you're acquiring someone else, to your employees? How are they going to be treated? You may have a very kind of family atmosphere. They may be treating it, if it's a public company, it's a lot more kind of I guess industrial in nature, for a phrase, where it's not treated as family, and there are a lot more rules and regulations. And how are your employees going to respond to that, and what kind of performance are they going to give you, especially if there is an earn-out formula? Those people who have been with you may kind of look at a transaction and say, I don't want to stay on, or what's in it for me? And they may come to you and say, I want a piece of this. I work so hard, and it can make it difficult sometimes in negotiating transactions. And when you look to sell, what's the tax structure? Is this going to be a tax-free deal? Is this a taxable deal? Is this an installment sale transaction? And how much are you going to really end up when you start kind of figuring it all out? Do you have some sort of recapture? I mean, so you got to sit down with your accountant and your tax advisors to figure out kind of what the most effective structure is, so that what you think although the contract may say you're getting X, when you really kind of boil it down, you're getting Y, and it's a lot less than the number you had in mind. And again, in all these things, as we talked about kind of early on in the process, you need to try to take emotion out of it. You don't want to kind of, as I said before, end up with some sort of remorse. And that's why many times, I think not many times, but it's very important to rely on your professionals, your lawyers, your bankers, your accountants, because they've been, in these transactions before. And if you've had long-standing relationships with these folks, they understand you and they understand your needs, and they're able to balance those. And they're a good lawyer or a good tax advisor, accountant, or a good investment banker is able to kind of help kind of bridge the gap sometimes between what you don't know about kind of the process, or kind of what's customary in the process, or what market is in the process, versus what you know about your business, and kind of taking your vision and your thoughts and putting into the right business setting.
And with that, we're going to take a quick break. You're listening to the In Black and White's radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see, so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz, and we've spent the balance of today's show speaking with Joel Mayersohn, a corporate securities attorney from the law firm of Retzel and Andrus, talking about what we're calling the business crossroads, a point in time where a business has to make a decision as to whether they're going to sell the business, be acquired, or acquire another business, or obtain additional financing to accommodate the growth that the business is seeking. And over the break, I actually got a email in from one of our listeners. It is actually another lawyer up in the Massachusetts area at the law firm of Rayford Pellegrino and Associates. And the question, Joel, is is based using this theory, financing the acquisition of a service company as opposed to the acquisition of a company with hard assets. So when you approach a bank to facilitate a loan as it regards the acquisition of a service company, let's say for example, an accounting firm that has minimal hard assets, what can you offer the bank as security for the loan?
Well, you can do a couple of things. Obviously, there are always personal guarantees, which are, and that's not really where you usually want to start. But you can look at, and it's difficult in a lot of situations to look at, what the accounts, which are the accounts receivable are, kind of to look at that and take a blanket lean on those. But obviously, as we all know, in a lot of service firms, the accounts receivable aren't necessarily something that can be predictable in a lot of cases, but that's another approach. There might be some small amounts of kind of equipment that's there that could have some security. So there are some difficult things ultimately to do that, but you try to get to find as many things as possible to be able to point to versus actual, kind of hard assets. And then what happens is the bank starts looking at really what the overall business performance is of the entity, and sometimes obviously your rates may be in fact a little bit higher because you don't have necessarily that security there. But at the end of the day, usually if the business is a solid business and the people are willing to stand behind it, you can get some capital to be able to go out and buy those types of acquisitions.
And so typically traditional financing in that regard is available.
It is available. It's a lot more difficult. The other times, too, if you do an acquisition of a service business, you may, and this is not always from the seller's standpoint, they may be willing, if you want to take back kind of a note so that you're paying, you may be paying them out of their cash flow, but if you're paying them a multiple out of it, that it may be a way that ultimately can be a little bit easier. So at the end of the day, you're not necessarily going bank financing, but you're using the debt of the acquired entity as part of it.
Are you seeing any private equity firms or any of your other venture capital firms potentially lending money to service-related companies?
I don't see a lot. I do see private equity firms that will kind of work with, have both a debt and equity component to transactions that are out there, so that they will provide kind of a blend, and ultimately the debt component may have some convertibility features, so that or a high enough interest rate where they ultimately become get that paid off on certain transactions, and they have an equity component. On true service businesses, there are some, if the model, if it's in their kind of sweet spot and in their model of what they're looking at, there probably are some out there, but probably a little bit more difficult to find.
And that would make sense, just because I guess it's hard to quantify really the revenue piece on the service side.
All right.
So I really, Joel, I want to sort of summarize what happened, what you spoke about today. And we've talked about throughout the show is that businesses hit this crossroads. They hit this point in time where they're stuck and they can't necessarily afford to support their growth based on their existing structure, and they have to revamp the way they approach their business, in that they either have to raise more money, they have to sell, or they have to, be acquired or acquire. And I think the point that you made, or the 2 points that you stressed very intently throughout the show, were that the first is they need to take the emotion out of their business, and they have to look at their business as a business and not their baby. And then the second point you made is that there's so much preparation and so many things that they need to think about that it's critical that they hire the right set of advisors, being you as an attorney, financial people, bankers, etc., so that they can actually put the right process in place, because there really is no right or wrong answer here. It's just what the answer is best suited for that business. And Joel, I can't thank you enough for being on today's program. To me, this was a fascinating topic, and I'm sure we could go on and on and on. But my friends back at the studio don't appreciate that. But again, I appreciate you being on the program.
Well, thank you, Peter. It was my pleasure, and I enjoyed it immensely, and it was an enjoyable hour.
Thanks again. Thanks to our sponsors, Retzel and Andrus, American Century Investments, and the acquisition for the executive search firm of Stephen Douglas and Associates. Next week on the program, we're going to do an interesting show about. We interviewed over 1,000 retirees, and we asked them if you could go back in time, knowing what you know now with regards to saving, and start over again, what would you do? And I think you're going to find some of the statistics to be fascinating. But again, thanks to Joel Mayersohn from the law firm of Retzel and Andrus. Again, you can download our program at the In Black and White's host page at Voice America Business. I'll be answering, and Joel will be answering a couple more of the emails that are coming in after the program. You can email me at peter@inblackandwhites. You can follow us on Twitter at peter.whites, or you can hit me on LinkedIn at Peter Weitz. Thanks again for listening. You're listening to the In Black and White's radio program on Voice America Business. Make it a great week.
Thank you again for tuning in to In Black and Whites. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.